Hey everyone, Steve Schleter here for you with market stats and MOFIRS. And today we're going to talk about some market-wide stats or national stats and local to give you some perspective on how what's really driving our real estate economy is more supply than demand. And we kind of know this, but look, how do we back it up so that we have a conversation with a would-be buyer or seller? We can help them understand what the drivers are in the market and why actually right now is probably one of the best opportune times to buy from the standpoint of having choice, which everything to me indicates that we will have less choice again in the not too distant future. And we'll talk about why that is as we go deeper here. Before we do that, let's just do a quick look at 7 days back at Bexar and Kendall County and see what's going on in our market. I'm going to share a screen. We're going to take a quick look at the dashboard. And as you will see, we have in the last 7 days, effective the 13th, today, 966 new listings, 755 pending. So a net gain of 211 listings net gain, price adjustments 1,535. We closed 322, so we're seeing pendings pick up over closings. So we're staying steady, it would appear, in terms of absorption. We are continuing to build a little inventory, and yet keep in mind we ended July. August stats aren't complete yet, but we ended July with 2.3 months of housing inventory, which is still a dramatic seller's market. In ALC meeting today, agents, particularly in the Bernie area, talking about continued multiple offers on properties. And yet in Bexar County, we're seeing quality houses on the market, some people not having to compete, and a lot less offers in some cases, particularly in the Bexar County market. And there's, the top 20% of houses are always going to go for top dollar. So that's a little bit about what's going on last 7 days. But let's go to this supply side economics and see what we can kind of learn here. I'm going to pull up PowerPoint slides for you. And this came from Gary at MegaCamp. And I want to interpret just a few of these slides as it applies to us at the local level, and what might be some MOFIRS that we can build into some of these conversations that we would have with folks in our database. And so when we look at this, in fact, let me just go ahead and go full screen in case you want to screenshot some of this. You can do this. Home sales annually. So if you look at a 5-year period and you take the period leading up to the Great Recession, we had a demand-driven market. We had supply. We had tremendous demand going up to 7.1 million in annual home sales, having 4 years over 6 million. And then, of course, the adjustments in the market came with the subprime mortgage crash. Then, as we climbed out of this, notice we only went 6 million plus 1 year, and that was 2021. We're projected to have right at 5 million home sales in 2022, which is actually on kind of a normal track. So what we're really doing is returning to normal in terms of demand. And yet when you look at demand 18, 19, 20, it was marginally over normal. I mean, I wouldn't sneeze at 600,000 homes, 1.2 million sides over, and yet compared to these times. And so really what's happening in our market is not as much demand drive, because we're kind of been just above normal to now normal is where we're trending now. And yet we're still only seeing 2.3 to 2.6 months of housing supply, depending on your market. And so that means, well, let's go talk about what it means. Let's drive in. So we go back to things we've covered before. Construction. We had massive supply feeding the massive demand that we had prior to the crunch in the crash that happened 2007-8. And of course, all that excess inventory, someone went to foreclosure, got absorbed in 2008, 9, 10, in these years that followed. And as we've talked about before, just to stay even, we've got to have a million housing starts a year. And we just got back to that, not quite there in 2020, just a little above it in 2021. 22 is kind of projected to be maybe there, just because of things that were already on the books. I'm concerned that 23 is going to fall below the line, and that is going to exacerbate the supply side challenge that we've all been dealt with. So what's going to happen is we're building a little inventory right now. We've got some factors that are going to put us probably within 12 to 18, 24 months tops, right in a place of constrained availability or inventory again, possibly bleeding to bidding wars and lots of multiple offers. So that would say the window of opportunity is now. So let's look at some things to back that up. Builder confidence ratings. So we are seeing the lowest we've seen since April of 2020. And, builder confidence declining means that builders right now in this moment are pulling back. The amount of starts that they're going to put down, they're going to get current inventories absorbed before they do dramatically a big push on housing starts right now. They're waiting out the economy. What is it going to be? And because confidence is low, they're pulling back, which means housing starts going, probably below 1 million in 23, maybe into 24. Depends also about whether developers are continuing to develop and put dirt on the ground. If that doesn't continue with projects that are already kind of in the works, if that gets mothballed, we could see a serious constraint in supply. Now, what does constraints in supply mean? It means rents are rising. They're raising rapidly with inflation. And so that has no sign of changing. So the person deciding to rent versus buy, and we'll get into a rent versus buy analysis in another session, may still want to choose the path of buying, and understanding today's interest rates, as we've talked about in previous sessions, are actually normal, and marry the house, date the rate. If the rates do come down, you certainly have the opportunity to refinance, but lock in a home today, especially when you have choice and it looks like supply could be constrained going into the years ahead. And the other factor really impacting us in Texas, and it'll be curious to see how this continues, and I believe it will, because of the amount of net migration of people moving from other parts of the country to Texas, is the amount of institutional purchases. You'll see Texas deep purple, 15% plus of home buyers are institutional buyers, buying property, turning them into rentals, taking depreciation, and it's a massive investment strategy, from everything to big hedge funds, retirement funds, and just general investment groups with big deep pockets. 28% in Texas were institutional buys. So all this is to say that this really, if we were to think about what are our MOFIRS today, it's that this is the window of opportunity. Right now, while there are choices in the market, while people are sitting there deciding what to do, we've got a supply situation still, and supply really doesn't seem to have any opportunity to go extremely high. Remember, the San Antonio Business Journal said we were 65,000 housing units short of a healthy housing market in San Antonio. So that being said, your MOFIRS are, it's a perfect time to buy real estate. We have supply, and we very well may not have substantial supply and bidding wars 24 months from now. And life's not a guarantee. The economy could go really crazy, stupid backwards with poor decisions on the part of our government. We could wind up in a big war, and yet people want to live in a home, and people are still moving to Texas, and all data points to continued ongoing supply challenges driving our housing economy here. Good time to buy is when you have choices right now. As Gary Keller says, rather than wait to buy real estate and wait. There you go. That's it. See ya.